Okay, we're at the top of the hour. Thank you for standing by and welcome to the AFS Best Practices Weekly Webinar. Our topic is COVID-19 Impact on Commercial Lending. This webinar will be approximately an hour long, and I would like to introduce our first speaker, Dean Snyder, Managing Director, AFS Vision. To enable open dialogue, we will be unmuting all lines. However, we ask that you self-mute, whether it is on computer audio or on your phone. To help us manage those that would like to ask a question or make a comment, we ask that you use the raise the hand feature. We will then be able to call on you. Additionally, you can also use the Q&A feature to ask questions. We will then leave some time at the end of the presentation so that we may answer as many questions as possible. We have recorded today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Dean?
Thank you, Renee. Welcome everybody to our weekly COVID-19 update for commercial lending, and hope that everyone has done well in this last week. And again, those especially directly affected by the illness, you are certainly in our thoughts and prayers. Today, we're going to have a focus on the Main Street Lending Program, and Doug Skinner, our Director of Regulatory, will be leading us in that discussion. I'll also take you through how we can support, how AFS supports today the SOFR requirements that are being introduced with the Main Street Lending Program. And we'll talk a little bit about the relief loan program, the PPP loan status, also continued work that the banks are doing around deferments and forbearance. You'll hear from a couple of other speakers, Derek Wise and Rich Coogan especially, to talk about what some of our clients have been doing, some of the things, ideas and so forth. Again, this is designed to be interactive, so we welcome comments, suggestions, questions as we go through the presentation, and then we'll wrap up with a little bit of talk about what we're going to be doing in future calls. So Doug, I think I'm going to turn it over to you to tell us a little bit about the Main Street lending facilities.
Thanks, Dean, and good afternoon to everyone. So last week we saw the Fed very dramatically expand the scale and scope of its various initiatives aimed at improving the functioning of various credit markets. Many of the programs that the Fed is now undertaking, that you're seeing them roll out to support the flow of credit, rely on emergency lending powers that they can only exercise in very unusual circumstances, but that unfortunately is exactly the position that we find ourselves in today. Some of the programs that you've seen the Fed roll out, they used as recently as 2008 during that crisis, but still others are actually being introduced for the first time ever. So including this program we're going to talk about today. And they're, of course, deploying these programs to an unprecedented extent, and it's enabled by the financial backing from Congress and the Treasury Department. Because some of these powers have never been used before, I think it would be unrealistic to expect them to run smoothly right out of the gate. Operationalizing these programs is proving to be an enormous challenge. You are all seeing that and experiencing that with the Paycheck Protection Program. Many of you on the line are moving mountains to get that money into the hands of your customers as we speak. But that's also why it's important that the Fed get the information and the draft term sheets out to the public early so that they can gather feedback on how to best operationalize these programs in order that they can be as effective as possible in addressing the intent of the legislation. So the federal government started first with the PPP program, which was targeted at the relatively small businesses, and now they're turning their attention to the mid-sized businesses, which are certainly having the same problems as the small businesses and are such an important group. The middle market is to all of the banks in terms of commercial lending and revenue. So what the Fed is going to do is, through a special purpose vehicle that they set up, they plan to directly finance up to $600 billion for mid-sized businesses. Now, by law, the Fed can't lend on an unsecured basis. So the program is going to be capitalized with $75 billion in Treasury risk capital provided by the CARES Act. So if you do the math there, they're expecting this program to be levered up by an 8-to-1 ratio. The Fed's going to hold as collateral 95% of all the loans being made under the program, as the plan is that an originating bank would originate a Main Street loan, retain 5% of each loan they originate, and sell the remaining 95% to the Fed's SPV. Now, one really important thing to keep in mind about the Main Street program, particularly in relation to the SBA and their Paycheck Protection Program. The Fed has lending powers, not spending powers. The SBA is a government-owned agency, unlike the Fed. The SBA routinely makes government-guaranteed loans. As you know, the PPP loans are forgivable loans if the borrower meets certain conditions over time, largely based around keeping their workers on the payroll. The Main Street program is entirely different. The Fed is not authorized to grant money to any beneficiary, so the Main Street loans are going to have to be paid back, and that fact alone is going to make these loans fundamentally less attractive than the PPP loans were. So if you look at the initial term sheet the Fed provided last week, it's very short on details. Believe me, the Fed knows this is not a finished product. Last Friday, Governor Quarles, who was on the Fed's board, said he thought the program was at least 2 to 3 weeks away from being operational. So the Fed is actually soliciting public comment on the proposal until tomorrow. So I'm sure we'll be hearing more about the program in the coming weeks, which we'll share with you as that information becomes available. So today we wanted to walk through the basic terms and conditions of these loans as they're presently constructed, and discuss some of the challenges the Fed is going to have to face in their quest to not only operationalize the program, but ensure that it does the most good for the most people, and as we said, meets the goals of the legislation. So the program has 2 main components: a Main Street new loan facility and the Main Street expanded loan facility. The new loan facility would issue loans up to either $25 million or 4 times the borrower's 2019 earnings before interest, taxes, depreciation, and amortization, commonly known in financial terms as EBITDA. The expanded loan allows banks to expand or upsize existing loans to borrowers up to either $150 million, 30% of the existing bank loan, or 6 times EBITDA. Now, if you have already applied for and even been granted a Paycheck Protection loan, you are still eligible to apply for a Main Street loan. But borrowers can only use one of the Main Street facilities, so either the new loan or the upsized loan. Another stipulation states that if you receive a Main Street loan, a borrower cannot then participate in the Fed's primary corporate credit facility. So that's a separate Fed program being set up to support $750 billion in credit to issuers of corporate debt. So you cannot participate in both the primary corporate credit facility and the Main Street program. But what they're doing is they're basically trying to spread the assistance around as best that they can. So in terms of eligibility, eligible lenders are envisioned to consist of banks, bank holding companies, and savings and loan holding companies. That's it so far. There is no mention of fintechs, private equity firms, foreign banks, even US branches of foreign banks, or any non-bank lenders. it's interesting because the US middle market has a very diverse group of lenders today, much more so than even 5 years ago. So those are notable absences. But since everyone on the phone today works for an eligible lender, to my knowledge, I'm going to leave those absences to others to question or even argue. Eligible borrowers are businesses with up to 10,000 employees, or, and it's important that it's not and, but or, up to $2.5 billion in 2019 annual revenues. And then borrowers further must be created or organized in the US or under US laws with significant operations in and a majority of their employees based in the US. Now, a little more on that. Importantly, there's no lower bound to the size of the firm that can participate. Although with the minimum loan size being $1 million, that's probably going to eliminate many of the truly small businesses, the micro businesses. But also with no lower bound in terms of the number of employees or annual revenues, this really creates a very wide range of potential businesses seeking credit. And that could create some real issues for the Fed in trying to make this a one-size-fits-all program for actually a very diverse group of borrowers. Next slide, please.
Get there. Okay.
So as we noted, there are two variations of the program, but they share many of the same features. Both facilities are for 4-year money with 1-year deferred P&I, and the borrower can prepay the loan without penalty. The suggested pricing is SOFR plus a spread of 250 to 400 basis points. I'm going to come back to that in a minute. There's also an origination fee of 100 basis points, which, as you will see, makes the loan relatively expensive as it's currently constructed, especially considering where interest rates are at the moment. And then there's a facility fee that goes from the lender to the SPV at the point of sale of the participation. And then there is a 25 basis point servicer fee paid on the full amount of the loan from the SPV back to the originating bank. So as I mentioned, the maximum size for the new loan facility would be the lesser of 25 million, or an amount that when added to the outstanding and committed debt does not exceed 4 times EBITDA. And the new loan facility is envisioned to be an unsecured loan. The expanded loan facility has very similar features, but the biggest difference being the maximum size of the loan is much larger. So the upsized loan can be the lesser of 150 million, 30% of existing and committed but undrawn debt, or an amount that when added to existing and committed debt does not exceed 6 times 2019 EBITDA. So if the loan you are upsizing is already secured, the expanded loan facility then could be a secured loan. So the term sheet that they put out says that any collateral securing an eligible loan will secure the loan participation with the SPV on a pro rata basis. There are a lot of unknowns yet regarding the treatment of existing collateral. I basically just told you everything that they published so far around collateral. Also, it's unclear if you have an upsized loan that is already part of a participation or a syndication, how that is going to work as well. Now, in terms of the loan sizing criteria, the references to 4 times debt to EBITDA for the new loan and 6 times debt to EBITDA for the expanded loan are particularly interesting if you are familiar with federal regulations, because those are watermarks. Those same watermarks also happen to be important guidelines the Fed uses in its supervisory leverage lending criteria. So actually in the Fed's 2013 interagency guidance on leverage lending, 4 times EBITDA is one of the guidelines they list in defining a floor for a leveraged loan. And 6 times debt to EBITDA is widely considered a bright line for flagging the most risky borrowers in the non-investment grade space. So long before this current crisis, actually, the Fed had been sounding alarms around leverage lending and leaning on the banks fairly hard to manage that exposure and risk appetite closely, which is why many banks had done exactly that, and a lot of the most risky leverage lending had moved out of the banking system into the shadow banking system. So one of the issues that the Fed is going to be faced with this Main Street facility is trying to strike a balance between potentially leaving certain non-bank lenders like private equity firms out entirely from any federal assistance, and avoiding the appearance of bailing out the private equity firms and the leverage firms themselves. So how will they avoid allowing certain firms to basically refinance their loans at par potentially? So you can see yet another example of the inherent difficulty they're going to have in designing a program as complex as this. Next slide, please. So let me make a few comments about how the Fed is thinking about the pricing of the Main Street facilities. The draft term sheet says that pricing will be SOFR plus 250 to 400 basis points. So SOFR is the Fed's recommended replacement for LIBOR when LIBOR goes away at the end of next year. The Fed is thinking about at least 4 different SOFR conventions or ways in which lenders can calculate SOFR, but they didn't specify which one they had in mind yet for the Main Street facility. I'm a little surprised that they didn't just say it's going to be 30-day average SOFR, because that is already being published daily by the New York Fed, so there would be no calculation or anything that the banks would have to do. Another thing that is a bit odd about that lack of specificity is that for another Fed program, the term asset-backed lending facility, or TALF, those facilities actually are tied to 30-day average SOFR, so they do have a precedent there if they wanted to use it. But it's also possible that they haven't specified the SOFR convention on purpose in order that they can kind of simultaneously get a read on the market's readiness to operationalize whichever version of SOFR they eventually decide on. So let's examine this proposed pricing a little further. Remember that the pricing for the Paycheck Protection Program for givable loans is fixed at just 1% in the initial period. And here the Fed is proposing a spread of 250 to 400 basis points over an index. So in this slide, we're contrasting spreads over LIBOR on very large corporate loans, so over 25 million. So we're trying to approximate a new Main Street loan, and looking at their spreads versus their credit risk rating. This slide is from our AFS Business Intelligence Services. As some of you know, AFS publishes very valuable market information every month on loan pricing in the marketplace. So at present, there are no US loans, to my knowledge, that are underwritten to SOFR yet, but we can use 30-day LIBOR spreads as a proxy, knowing that SOFR and LIBOR are not the same. But this comparison can still hold. So notice where loans with a LIBOR spread of 250 to 400 basis points typically fall. So many of these are to borrowers who are not just solidly in the non-investment grade category, but might also commonly be considered criticized or problem assets. Plus you have all the fees that go on top of that spread. So you start to think about the type of borrower that would be in play today at that price point. So this is not at all a highly concessional rate by any stretch. So this is just another reason that the feedback loop now with the Fed is so critical. They have to price this program in such a way that it is sufficiently attractive for borrowers, but also motivates the banks to participate as well. Otherwise, the program will not meet its objective. Next slide, please. So both the lender and the borrower will have to adhere to certain conditions to participate in this program, many conditions. Lenders will have to certify that loan proceeds will not be used to repay or refinance any existing debt with the borrower, that they will not cancel or reduce any existing lines of credit, and that they meet the CARES Act conflict of interest requirements, which basically just means that the president or the vice president of the United States or any member of Congress, family members, can have any controlling interest in the lender or the borrower. Borrowers, on the other hand, to obtain a loan, they will have to attest to a number of statements and conditions as well, beginning with the fact that they are seeking financial support because of COVID-19. They will also have to certify that they will not use the proceeds from the loan to pay off other debt, and they will need to make reasonable efforts, so a very interesting legal term there, to maintain their payroll and retain their employees in order to receive a loan. So I'll also point out that this language, reasonable efforts, appears to be watered down somewhat from that which was actually in the CARES Act pertaining to the mid-sized program that the CARES Act envisioned. I believe the original language said borrowers would have to maintain their payrolls at 90% of what they were before the crisis. So they've watered this down a little bit. Borrowers of the Main Street facilities will also have to follow restrictions on compensation, stock repurchases, and the payment of dividends as were originally outlined in the CARES Act. So with so many strings attached to the Main Street facilities at the current time, borrowers are going to have to think through if they want the government involved in certain managerial decisions affecting their company, including capital allocation, compensation. Now, on the other hand, there are certainly going to be companies where that isn't an issue. Perhaps they don't pay dividends, and the executive compensation limits that are defined in the legislation are not viewed as restrictive based on their current compensation structure. One other point I wanted to make here, it's interesting that borrowers are prohibited from using the funds to repay or refinance existing loans or lines of credit. So it's possible that this statement, in combination with the debt to EBITDA restrictions we talked about, is an attempt to try to avoid this program being used to bail out private equity sponsors and leverage lenders. But that's just a guess on my part. Next slide, Dean. So in conclusion, the Fed has a lot of questions to sort through and provide clarification on, which is why we're probably looking at least 2 or 3 weeks before the first Main Street loans can even be considered and funded. So I've listed some things here that have to be addressed. There's certainly many more. It's very important that they get the pricing of this thing right. It has to strike the right balance between being attractive for the borrower, but also viable for the bank. Otherwise, why wouldn't the bank just lend to a higher risk company following their own internal underwriting criteria? Would it even be worth it to go to the trouble to originate a Main Street loan, even if you could offload the 95% and be assured that there was no further recourse to your bank? Banks will almost certainly want more detail on the underwriting criteria and recourse given the extensive list of reps and warranties in the program. They will want assurances that the 95% portion, for example, that they sell to the SPV can't be put back to them under some set of circumstances. Another question, as it's presently constructed, it seems that a bank could make a Main Street loan and then just sort of see how it goes. And if the loan performs, they keep the entire loan, or maybe they sell it at a premium to an investor. But if it looks like it's going south, they sell it to the SPV. So I'm sure that's not what the Fed envisioned. So it certainly seems like a loophole that they'll want to address. And then the Fed also needs to address the, as we talked about, the broad range of companies that presently qualify, as they have such diverse financing needs. So perhaps instead of a one-size-fits-all program, we will get a few variations of the Main Street program. Of course, if you are a non-bank lender, such as a private equity firm or a direct leverage lender, you have questions about your own eligibility. But as I said, I would think the Fed wants to walk a very fine line there if possible. They need to design a program that provides sufficiently aggressive funding on the one hand, while trying not to bail out the weaker players like the leverage loan providers. And that won't be easy. So once the Fed gets all the details sorted out, the challenge will then turn to implementation. And of course, these lending programs will only be attractive if people think there is going to be a robust recovery on the other side of this, which is certainly why the government is already talking about additional phases of relief and support. And there's no question that the stimulus is going to grow even bigger than it already is. Dean, I'll turn it back over to you.
Thank you, Doug. And I'll ask if anybody has any questions at this point for Doug, and then I'm going to start moving into talking about the operational side of the SOFR pricing for these Main Street loans as we move into that. Any questions for Doug so far? With the announcement of using a SOFR-based pricing, of course, that got everyone's attention very quickly last week. And as Doug said, you know, this ties into what we've been covering in our LIBOR transition SOFR webinars. It's been going for over a year now, and there are 4 different interest conventions, right? 4 different methods for calculating SOFR interest. And while the guidance for the Main Street program doesn't specify which of those 4, there was a survey that came out from the Fed and the ARC, I believe it was either Thursday or Friday of last week, and they specifically asked banks for what their readiness would be for 3 of those 4 conventions. Okay, so to try to get an idea of where we think the Fed is headed with this, the first 2 that they talked about are listed here on the slide, which is a daily simple SOFR and a SOFR compounded in advance. Again, as we said, for our AFS clients, the good thing is those are supported today in your version of AFS, whether it's AFS Vision or Level 3, and I think regardless of what release level that you're on. We listed here these first 2 conventions, Daily Simple with the website link where you can find that. Of course, this is your published daily SOFR rate. A note here, though, that this rate is published on the following day. So if you were looking for SOFR's rate for April 15th, you would find that tomorrow morning on the New York Fed's website. So in dealing with that, and this would be a daily rate, changing potentially daily, you'd have to consider that and possibly build in a look back like LIBOR today, which has a 2-day look back built in. You could do that with your index rate to build in a look back of 2 days or whatever number of days, that would allow you then, if the borrower were to borrow today at SOFR, you would have a rate to use by using a look back period. You also would, of course, have to consider the billing in advance at the end of the pricing term. Because again, if you're going to produce a bill X number of days before it's due, if this rate's being published daily, you're not going to know the remaining few days in that billing period. So that's why, again, a look back is used so that if you had 2-day look back, you could produce the bill 2 days in advance and so forth. Again, those familiar with billing in AFS know that we do have an accrue 2-date feature. So you could continue to accrue for the full period and then use an accrue 2-date to stop the accruals and have the bill be due 2 days after the period or 5 days after the period. It's going to depend, I think, on the lender and the market and how they react to that. So the other convention is SOFR compounded in advance, and this, as Doug mentioned again, is based on a published average rate. And we have the URL here. These are being published now daily, and there's actually 3 tenors, a 30, a 90, and 180-day average rate. So they can be tracked as index rates in AFS, and you can then take your loans, tie them to one of these 3 indices, and use the traditional spread or margin that's defined on the prime schedule or index rate schedule within AFS, so that these would be rates that would then be locked in for a period of time over the pricing period. Again, very similar to the way LIBOR would work today. The third method, which is listed here, of course, is the compounded in arrears, and that's the one we've been having sessions on. And we know compounding in arrears is a new calculation method for commercial loans for our banks. And so AFS has indicated we are in the process of developing that capability, and the expectation was to have that rolled out by the end of the third quarter. So a lot of people were saying, well, why did the Fed, when they sent out this survey last week, why did they ask about readiness for compounding in arrears? Surely they know that the banks aren't ready for this. And I think they do know that, but they just felt that they needed to send that out kind of as a verification. And I expect the survey results, much like we filled out the survey as a vendor, the banks will certainly indicate as well that they're not in a position to do compounded in arrears interest today in their own platforms, but are continuing to move towards that towards the end of this year. A couple other operational issues around SOFR, of course, is there were questions about the holiday calendar, and the SOFR calculations would be using the SIFMA calendar, similar to what LIBOR uses today. So for those banks that are using our level 3 system today, you already have an alternate calendar, which is set up for the LIBOR holidays, and that will work for your SOFR, whether you're doing daily SOFR or SOFR compounded in advance. For AFS Vision customers, of course, we have multiple alternate calendars. So if you wanted to be as specific to say there's a LIBOR calendar versus a SOFR calendar, you could do that. The only date we think is potentially different between LIBOR and SOFR calendars is Good Friday. And of course, again, thankfully, we just passed Good Friday. So that's not going to come into play for the mainstream lending loans at this point. We would certainly have until next year, 2021, when Good Friday falls. And in the meantime, we'll be looking at that to see if any adjustments need to be made for that particular day in the calendar. In terms of billing statements or notices going out using SOFR, again, we've talked about changes to the statements and notices, but again, those changes are for the compounded in arrears interest convention. So again, assuming that the Main Street facilities are going to be using either SOFR, daily SOFR, or SOFR compounded in advance, we do not see any need for changes to your current billing statements or notices. So you should be in good shape with those. All right, any questions then about certainly the Main Street program or the operational issues around doing SOFR-based pricing for these? I have to check to see. Okay.
No questions as of yet, Dean.
Okay. Again, if you have questions as we go through before the end, bring them up or certainly send us an email and we will respond and provide those answers to everybody next week or in the interim. So recap from prior kind of old business, right, from our sessions. I know everyone's dealing with the BPP loans and the booking of those. And again, not going to go through these details here. Just a general reminder, we've been working with a few of the banks to help them in the booking. There's some different options here that you are pursuing or could be pursuing. So again, a reminder that if you have any questions or are looking for assistance in these areas, certainly reach out to us. Now, loan deferments and forbearance, I said I'm going to let Derek Wise and Rich Coogan comment a little bit about this, because at the same time you're trying to deal with this new influx of new PPP loans to book, you're also still dealing with the existing loans and how to make changes to terms for the COVID-19 situation. So Derek, do you want to talk a little bit about, as I said, a report from the front lines of things you've observed?
Sure. Thank you very much, Dean, and thank you all for your time this afternoon. So we do understand, you know, as soon as you're trying to book all of these new loans, you have a backlog as well, facing servicing challenges for the loans that you're actually servicing regularly that are already on the books, related to both skip payments and interest deferrals. Now, for the purposes of our discussion, I'd like to separate these concepts a little bit. I'd like to say that a skip payment would be the act of skipping due dates, interest, principal, both. So for that, on either Level 3 or AFS Vision, you know, you can edit those schedules to skip those payments. Interest deferrals, on the other hand, involve taking the current accruals or perhaps accruals up to a certain date, even into the future, and deferring that. Most commonly, we're hearing that folks are deferring these interest accrual amounts to maturity. So in both AFS Vision and Level 3, both systems are flexible enough. You can do this by creating a second charge header. That's what our clients are doing today that are working through this. And they're using one charge header to represent the contractual interest that you want to bill regularly when you return to a regular payment. And then the other charge header can represent the interest deferral piece. Now, while I'm kind of separating these ideas, a skip payment versus an interest deferral, what we've heard from at least one client is that 99% of the time, when these are coming in from their RMs, coming in even from customer requests, 99% of the time, it's a combination. I'm skipping payments for a couple of months, and I'm deferring some element of the interest accrual either to maturity or to some point in the future. Now, again, the good thing is AFS Vision and Level 3, both systems, very flexible. They allow you to do these things, but there are some analytical pieces that have to be considered. For instance, where is the billing? Has it already occurred? If it has occurred, what has been paid versus what hasn't been paid? Do I need to unbill anything? Do I need to correct any of that? The good news is on the Vision front, given it's a real-time application, some of you are aware that we can unbill in real time, and we can unbill multiple invoices in real time on Vision. So that means that you can do these types of functions, if it includes unbilling, all in a single day, as opposed to having to wait for multiple batch cycles, which you would have to do in the Level 3 world. We would like you to know that we are actively working with various clients right now, either by looking at their procedures, providing commentary and assistance, or we're even talking to folks, you know, that we're using Relay Tool and some other tools to automate onboarding. We're looking at some capabilities of being able to automate to streamline this process where it's available, and we're very interested in talking to folks about that. On the AFS Vision front, there is a capability to actually freeze. The freeze formula is a little more detailed. You can actually define a freeze formula to freeze billing only, so that as you're working through this, trying to figure out how to defer, do I need to unbill, et cetera, you can prevent any additional bills from dropping from that for that customer, so you don't have any notices going out as you're working through that process. And again, we're looking at ways to even assist with the automation of that as appropriate. If you'd like to know more, or you just want a second set of eyes, you want someone to take a look at your internal procedures, we're already doing that for some folks, some of the folks even on the line today. We're more than happy. Just reach out through, your established channels, get in contact, and we're more than happy to help you through that process and help you figure out what the best way through this process is. As soon as one shoe drops, another shoe drops, right? So as soon as you're through the booking challenges, the next backlog is the continuous service of these items. So we're more than happy to assist you either on the level 3 front or the vision front. And I'd like to, at this point, turn it over to Rich Coogan to cover some of the finer points on the level 3 side that I may not be entirely aware of. Rich, are you out there?
Thanks, Derek. So yeah, over the past few weeks, we've had many conversations with different banks about how they're handling the loan deferrals. So a lot of things that Derek had mentioned is true for level 3 as well, and I'll go through a few individual things here. But as you're painfully aware, there's really no magic solution to how to deal with this and the best support your customers. A few of the things that we've talked to the banks with, and I think the number one thing is, the bank has to come up with what their policy is. And I know that's been difficult because to steal a line from Doug, there really is no one size fits all. But for us, it's even harder because, every bank we talk to, kind of has a different policy or doesn't have a policy yet. So trying to come up with solutions can be difficult. So some of the things that, we try to ask and figure out when we're talking to the banks, what are you planning on deferring? Are you deferring principal and interest or just interest? How long are you going to defer it for? How are you going to collect it when this is, when we get back to some semblance of normalcy? Are you going to try to spread out the money that has been deferred over a number of months? Are you looking to just move the loan out 3 or 4 months and spread it out that way? Are you looking to collect everything at the time of maturity and just defer it for that long? So there are some of the questions that have been discussed with different banks. And then just like with Vision, some of the things we've talked about have been, setting up separate charge codes, for the deferred interest period, repay types. If there's amortized payments, how can we deal with changing maybe repay types to a repay type 5, which is kind of like a negative amortization type thing that helps out with some of the billing later on after you come out of this. The big problem that I think everybody's facing is how are we going to recoup the interest? So, it's easy to say, well, we're just going to defer everything for 90 days, but now you have 90 days of interest. And as people, the servicing and operations folks on the phone are aware that, there's no easy way then to just say, okay, I'm going to spread that $3,000 of interest that I deferred over 3 equal payments or 6 equal payments or whatever to try to recoup it. So that's been a challenge. Some of the things that we've discussed that could be helpful, Derek talked about freeze formulas and billing. In level 3 with the bill type code on the obligation record, you can go in and say, I want to make my bill request only. Why is that important? That's important because if you're getting close to a billing window and you still haven't, processed your transactions to your billing schedules to defer these payments, you obviously don't want bills going out. So you can change that value to a request only with just one transaction to the obligation record, and no bills will drop at all. Then once you get your schedules corrected, and as Derek said, in Vision that might be a lot easier because of the way you can unbill multiple outstanding invoices. And the real-time nature of vision, that's a lot easier. But in level 3, you may have to put that bill on hold for a day or two until you can get all your schedules created. So that's an easy way, one transaction to go in and say, make a request only, and then, turn it back on to your detail bill, your summary bill when you're done. The other option is to, go into the billing schedules and change your frequency. But, that involves more transactions. And as you have to go in and re-enter the whole billing schedule. So that could get a little cumbersome. Another thing that we've talked about, we haven't talked about too much in level 3, but there is a loan extension transaction in level 3 where you can go in and say, I want to extend this loan 3 months, and then it can automatically create the billing schedules, put them out for the due date 3 months out in the future, or 4 months or 5. You select the number of months. And then also move the maturity date out on the loan. So if you're just saying, well, I'm going to move maturity date out 3 or 4 months, not do anything for the next 4 months, and then pick up billing again 3 or 4 months from now, we have a transaction. It's 1385 transaction that you can just enter one transaction, and it'll create all the 1370 billing schedules, 2301 to change the maturity date. So that could be an option if it's just an easy extension you're doing. And just moving everything out a certain number of months. So as Derek said, we're here for you. We've done the same thing in level 3. We've reviewed procedures that banks have written. We've tested various different scenarios on our own here to see what works and what's helpful. So we're here for you. If you need us, contact us, and we'd be happy to get on a call or share, any information that we have that may be helpful to you.
Thanks, Rich. And we did have a question while you were speaking about how banks are tracking the deferment skip payments, whether they're using a specific code. We know that at least one bank is tracking these as a minor modification. So depending on your version of level 3, you would have this, as well as on Vision, with the ability to differentiate between a minor, a major modification, and a renewal. And so that bank is tracking that date for a minor modification. There are other options as well. Transactionally, you could use a reason code to keep track of it as well. And on the level 3 side, I don't know if there's any additional options for tracking that Rich would like to share that may be relevant for Vision as well. But there are multiple options for being able to track this as an accounting event.
Yeah, just one other thing, Derek, with the 1385 transaction I mentioned, there is a field on the obligation record that tracks how many times you've extended it and things like that. So just like there is for modifications and renewals and whatnot, there's an extension tracking.
Sure. Yeah, so you could use the extension to keep track of these and keep track of the number of times as well. That's a great point. Thanks,
Yep.
Rich.
Okay.
Well, thanks, guys. If there's anything anybody else needs or has questions about, again, reach out to us for that. As far as going forward, just some upcoming topics. So we are going to be diving into the whole forgiveness aspect. Once we get past making these loans and adjusting these loans or whatever, we know certainly for the PPP program, there's going to be this forgiveness phase. And we're studying this very closely in terms of what are the accounting implications? How is that going to be represented? Certainly reporting, certainly regulatory reporting, and just operational issues about forgiving loans, forgiving parts of loans, and so forth. Again, the functionality, I think, is there today in AFS to do this. We're going to try to give you some more details around what we're hearing from the regulators about that. And certainly Doug will be back to give us updates on the Main Street lending program. As he indicated, there's a lot of things that still have to be worked out. So we'll be doing that. And again, if anybody has any other suggested topics that they would like to hear more about from AFS, we certainly welcome your feedback for that. So other than that, I appreciate everybody's time today. Thanks to our team. Again, for everybody, please stay well, be safe, and we'll look forward to talking to you next week. Okay, thank you very much.